All right, Google gave us one hell of a ride here. Uh, I originally bought this Leaps contract for $58.10. Now, the trade moved in my favor, and as it kept moving higher, I kept raising my stop to protect more of that profit. I do that all the time. Just a trailing stop loss, or a trailing stop is what it is. Then Google suddenly got hammered today. I wasn't even watching, and I just noticed that I got stopped out. Um, the stock dropped about 5% in literally a matter of a couple minutes. And that drop is what triggered my stop at $103. A short time later, the contract itself was sitting roughly around $96. So instead of riding that entire move down, my stop got me out of it at 103, locked in that 77% profit. So that's exactly what the stop was there to do. But after I looked at what actually caused the sell off, I didn't believe my long term Google thesis has really changed. So I bought back in. And in this video, I'm going to walk you through the original leaps, the 2 point credit spreads, and what happened during that sudden drop when I decided to reopen a brand new Google position. Now, before we go any further, this video is for educational and informational purposes only. Nothing I am discussing should be considered personal financial advice. Options involve substantial risk and they're not appropriate for every investor. Always do your own research and make decisions based on your own financial situation, goals, and risk tolerance. All right, let's put everything together because there are a few different pieces to this trade. On July 23rd, I opened the Google 300 290 put credit spreads. I collected $257 for each spread. The following day, I purchased the original Google Leaps for $58.10 or $5,810 per contract. Now, Google recovered from its earnings drop a hell of a lot faster than I expected. On July 31st, I closed both credit spreads at different profit levels. If you remembered in my last video or a couple of videos ago, uh, I closed them out at different intervals as I was scaling out of them. The leaps kept moving higher, and I continued just moving my stop up behind it as I usually do. Then today, Google dropped approximately 5% in just a few minutes. It was a crazy drop. The drop triggered my stop loss, and the original leaps was sold for $103 per contract. Now, once I figured out what caused the sell off, I quickly reevaluated Google. I decided that the long term thesis is still intact. So I purchased a new June 17th, 2027, $370 call for $52.80. The original trade is over. This new Leaps is a completely separate trade with new entry, new risk, and a new plan. All right, so here's how I managed the stop on the original Leaps. So my first stop was at 89, and then as the trade kept going up, I raised it to 92, then eventually to 103. Now I wasn't trying to guess the exact top. I was just simply trying to give the contract enough room to keep working while protecting the majority of my profit I already made. Then Google dropped about 5% in a matter of minutes. The drop is what triggered my stop. So I was filled at 103, and the contract continued to fall roughly to around $96 right after that. So the stop potentially saved another $7 in contract value, or 700 bucks per contract during that 5% drop. Now, could Google have bounced right back? 100% it could have. But sitting there in the middle of a 5% drop, trying to make an emotional decision isn't exactly a great plan. So the decision had already been made. If the contract hit my stop, I was out. So it hit my stop, the position closed, and the profit became real. That's what the damn thing was there for, to be honest with you. All right, now let's look at the final result from the original leaps. I purchased it for 58.10, and since options contract represents 100 shares, my total cost was 8,000 or $5,810 a contract. So the stop got me out at 103 or $10,300 per contract. That produced a realized profit of $4,490 per contract. That's 77.28% return in 12 calendar days or 9 actual trading sessions. That's a hell of a number. The chart also shows an annual pace of roughly 2,351%. Now, you know, don't get carried away here because that number is pretty much useless. Honestly, I mean, it doesn't mean I expect to make 2,000% a year, and it sure as hell doesn't mean that this kind of trade happens every 2 weeks. It's just the mathematical pace of one unusual fast trade. Now, the real number is already good enough, 77% realized in 12 days. I don't need to dress that up any more than it already is. So the put credit spreads gave me another way to profit from this bullish Google thesis. So both were 300 290 put credit spreads, and I collected 257 for each one. I closed the first spread out for 109, which means I bought it back and I paid $109 for it. Now that left me with a profit of $148, or roughly 57.6% of the premium, of the available premium. So I closed the second spread the same day for $65. Now that one produced another $192 in profit. So that captured roughly 74.7% of the premium. So together, those spreads generated approximately $340 in realized profit. And the exact number after a tiny regulatory fees was what, 339.68. So I'm just calling it 340 because we don't need to make this any more complicated than it already is, right? So based on that maximum risk of 1486, the return on risk was approximately 22.88% in 8 calendar days. So once I captured that as much of the premium as I could, I was perfectly happy taking that money, freeing up that buying power and removing any remaining risk. So, what caused Google to get smacked like that? The sell off came after a pretty significant reshuffling of Google's AI leadership. Um, Hazabis stepped away from the day to day management of Google's DeepMind, but he didn't leave Alphabet. He remained chairman of DeepMind and became Alphabet's chief scientist. So, Corey took over as the operations leadership, and Jeff Dean and three other senior researchers also left to form a new company called Discovery Loop, which Google is actually backing. So now these are important people. I'm not going to sit here and pretend the leadership change at this level meant absolutely nothing. But you gotta take the news. You take the news seriously, but you figure out, okay, does it change the reason why I own the company? But is Google's AI or entire AI operation, did it suddenly vanish in 10 minutes? So this is one of those largest, best funded, and most capable technology companies on the planet. It still has the infrastructure, the data, the talent, and a shitload of resources behind it. Okay. So the market saw a headline and reacted immediately. Now I stepped back, looked at what actually happened, asked myself one simple question: did this news break my long term Google thesis? For me, the answer was no. There was a legitimate uncertainty, um, but I thought a 5% drop in minutes was a definite overreaction. This is what opened the door for me to buy it again. Once the stop triggered, I didn't immediately jump back into the exact same contract. I looked at Google again. I went through the available options and decided how much capital I wanted to put back to work. So what I ended up doing was I purchased the June 17th, 2027 370 call. I paid $52.88 or $5,288 per contract. Now, at the time I entered, the delta was approximately 0.58. Now, that gives me meaningful exposure to Google's movement without requiring the capital needed to purchase 100 shares. Now, the expiration break even is 422.88. Now that matters if I hold the contract all the way through expiration, but I'm not married to this thing. I could raise another stop, take profits, and close it whenever the trade tells me it's time. So this isn't some kind of free position just because the first trade made money. That entire 52.88 is at risk if the contract eventually becomes worthless. This is a brand new trade. It's a new entry, a new risk profile, and it'll be managed based on what Google does from here. This is probably my favorite part of the entire sequence. The original Leaps was sold for $10,300, and the replacement Leaps cost $52.88. So I was able to open up a new position using only about 51% of the proceeds from the original sale. Now that left me $5,012 available as cash and dry powder. So you can also look at this from the profit side, right? The first leaps produced 44.90 in realized profit. That profit covered almost 85% of the cost of the new contract. So I only needed another $798 beyond the original profit to establish the replacement position. Now, I want to be clear about something. That doesn't make this trade free or risk free. If the contract goes to zero, I could lose the entire leaps plus the profit and plus my additional $798. But I'm still able to participate in Google's potential upside while putting substantially less capital back into the trade when I just got done taking it out. Now, I protected the original winner. I looked at the reason for the drop and I redeployed only the amount of capital that I believed a new opportunity justified. All right, let's look at the entire public Google case study together. For the model, we're tracking one original Leaps contract and two put credit spreads. The original Leaps required 58.10. The maximum risk across those two spreads was 1486. That gave us a total starting model capital of $7,296. The original Leaps produced 4,490 in realized profit, and the two spreads added another 340. Now that brings our total realized profit to $4,830. That's a realized gain of approximately 66.2% compared with the original model capital. After adding those profits, the model equity increased to $12,126. The new leaps cost $52.88, leaving $838 in model cash. At the time of this recording, the new leaps was worth approximately the same amount. It's flat as of the time I'm actually putting this video on. So what we add to that remaining cash, the complete Google case study value is the same. The important distinction is that 4830 from the closed trade is realized. The new leaps is still open, so it's got value, and the overall case study result will continue moving from here. The whole point of this video and this whole series is to track these particular trades that we're making inside of this portfolio and tracking all of the wins, the losses, the all of the trades that we're going to be placing. It's in real time and it's a real case study. So you're going to be able to see exactly how things are managed in from a real trader doing real things. This is all going to be tracked perfectly as well as perfectly as I can to show you everything. So I'm sure there's going to be losses along the way too. But this trade definitely worked out pretty well so far. The biggest lesson here isn't that the trades made money. The stop ends a position. It doesn't necessarily end my belief in the company. My stop did exactly what it was supposed to do. Google dropped 5% in minutes. My stop was triggered at 103. It kept me from sitting there while the contract fell roughly to $96. Once I was out, I could step back and evaluate the news without worrying about protecting the original profit. I wasn't emotionally attached to the old contract, and I wasn't pissed off just because it took me out. I looked at the catalyst and asked whether it changed my long term thesis. It did not. If I believed the leadership changes seriously damaged Google's future, I would have taken the profit and just stayed out, right? But I wasn't that was not my conclusion, honestly. I thought the market reacted more severely than the news justified. So I opened up a brand new trade with substantially less capital. I protected the winner, review what caused the move, reevaluated the thesis, decided whether another trade makes sense. Getting stopped out doesn't automatically mean we were wrong. Just buying it back doesn't mean the stop was a mistake either. Those are two separate decisions made at two different points in time. So that's where the Google case study stands today. The original leaps, both put credit spreads are officially closed. Together, they produced $4,830 in realized profit for the model. The June 27th 370 call is now the only open Google position we're tracking. I'll continue updating this trade and showing you exactly how I manage it. That may mean raising another stop, taking profits, adding some protection, or just admitting the trade didn't work. We'll see what happens, what Google's going to give us. So if you found this case study helpful, give this video a like and subscribe to Practical Income Investing. And let me know in the comments after a drop like that, would you have gotten back into Google again? Or would you have just taken the profit and walked away?